Welcome to The Riff, where writer and investor Byrne Hobart and I discuss the major inflection points caused by technological change. Our weekly conversation covers the obvious and not so obvious ways in which markets and businesses will adapt as a result. Let's jump right in.
Byrne, I want to start by talking about the pod shop model. You wrote an article about what would it look like if it blew up, and you seem to write about it every few weeks. Maybe we can rack up as to why you find it so interesting, and then we can get to the substance of your piece.
Yeah. So I worked at a hedge fund that was a practitioner of this model, and I was just less aware of kind of how the model worked at the time, in part because I think part of what the model does really well is it separates the different tasks that the different people in the fund should do. So the goal of the analyst is to come up with good trades, good investment ideas, and then the portfolio manager is the one who is deciding how to fit those into a portfolio. And then there's a risk team that's trying to figure out what is the way to what constraints do you put on how portfolio managers construct those portfolios. So I was kind of unaware of how all of this worked, but the basic idea of the pod model as it is practiced today, and it's evolved over long periods, is that you have a fund, there will be a bunch of different teams that are each running different strategies, and within equities, which is the space I know best, what they try to do is identify all of the different variables that affect multiple stocks at once, whether that is what industry they're in, or the size of the company, or geography, or whether the stock has high or low momentum, or whether it's statistically cheap or expensive. What people have found is that a lot of times these factors are just major drivers of returns. So if you were a growth and momentum investor in the late 1990s, you did really, really well, whether or not you were talented. And if you were such an investor and it's 1999 and your portfolio is up 70%, you feel really, really smart. But if someone runs a regression on the factor exposures that you have in your portfolio, they might find that actually, given all of that, you should have been up 80%. So you were actually subtracting a pretty substantial amount of value, but you weren't aware of it because your job was pick internet stocks, and internet stocks were all going up. So over time, there's been kind of pressure from outside investors and then pressure within the fund to figure out to what extent can we attribute someone's returns to their specific skill, and to what extent can we attribute those returns to luck of the draw, that they happen to be a .com analyst in 1999, so that they were just automatically going to make money, or they happen to be an oil analyst in the mid 2000s. And again, like all of those stocks were just rocket ships for a while. And if you identify those factors, what you can do is you could say, okay, here's someone's return net of those factors. And the next thing you could do is you could say, why don't you just run your portfolio such that you don't actually have exposure to these factors? So we're not paying you to, we're not paying you to happen to be lucky in that your mandate is buy US stocks and US stocks went up. We're actually paying you to identify particular companies within that set of statistical clusterings that will actually do relatively better or worse. And what's interesting about that model is that when people identify those factors, what they're trying to do is figure out what actually drives unusually good returns. And can we explain when someone has a bad year, can we explain that as they didn't suddenly get really bad at investing, but they were unlucky in a particular way? And once you can identify those factors, and once you can systematize them and just say, here's what a portfolio that is, purely momentum driven looks like, or here's what a mid-cap portfolio that is weighted towards momentum and value and is focused on the US, like here's what that looks like. Like once you can do all of that, you can tell people to hedge it out. And if they hedge out every risk that can be measured, then what you're left with kind of by definition is skill. Like the returns come from skill as best we can define it. And that does lead to some really annoying things for portfolio managers. Like a lot of their job is to find these really fine-grained differences between extremely similar companies. So, for example, if you're running a factor neutral portfolio and you have to have a position in your, like, cruise lines are part of your coverage area, you're basically long to short to at any given time. You're always just trying to figure out, okay, who are my two favorites? Who are my two least favorites? And so you're betting on these really incremental changes, but it does mean that if you make money doing that, we know that it's not because you happen to be long or short at a time that was good or bad for the industry. It's that within that industry, you were actually able to identify what drives specific stocks. And when you have one person doing that, they're typically, my understanding is that the return target that someone would aim for in terms of gross returns is like low single digits in percentage terms, which sounds really, really low. But if you lever that up substantially, which you can do because you know that all of the kinds of measurable risks that we see, those investors are not taking. So you lever up those portfolios and you have a bunch of them from a bunch of different people doing different kinds of strategies in different industries. What you end up with is this meta portfolio of just kind of abstract, pure alpha. And it's like as close to pure alpha as you can get if you're running that model with very tight factor constraints. And that is a product that that a lot of investors really want. And people will often compare hedge fund returns to the S&P and will say that the S&P, you could have just bought the S&P and done better than a hedge fund. Like this year, you almost certainly, anyone who invested in the S&P did better than the average hedge fund. But the hedge fund's mandate is not beat the S&P every year, at least if it's running like a factor neutral pod style strategy. Their mandate is not beat that index every year. Their mandate is deliver the highest possible uncorrelated returns. And you tend to hear a lot fewer people comparing hedge funds to the S&P 500 in years when the S&P is way down, because the hedge funds do tend to outperform. And that is it's like annoying to me because most years the market is up. So most years you can say everyone who allocates to a hedge fund is dumb. And then in years where you can't say that, it's just not especially interesting to say, wow, it turns out that the handful of extremely sophisticated investors who control very large pools of capital, allocated that capital to a handful of really, really big firms that most of us will just never have a shot to invest any money in. Like, yeah, they had a good year. Like that's not an especially exciting thing. It doesn't really vindicate them. It just is kind of what you get if you have that kind of access and you control that kind of capital. So I think that's why the narrative on these funds will always be falling short of reality. But it is like, it's a fun model. And in part, what I really like about this model is there's this old joke about hedge funds, which is that they are a compensation scheme masquerading as an asset class, because the original appeal when the first hedge fund was founded by Alfred Winslow Jones, the appeal of it was, unlike a mutual fund, you can be levered, you can go long, you can go short, you can trade derivatives, you can do commodities or currencies or whatever. Although I don't think they did very much of either of those, but you're very unconstrained in what you can do, and you get paid a percentage of the profits. And when markets were less efficient, I think a lot of investors in hedge funds were pretty tolerant of the fact that, if the market's up 20% this year and the fund they invested in is up 30%, like when they pay that 20% performance fee, most of what they're paying for is the fund had exposure to the broader stock market. And that's why it went up, because they're still making their 30%. So they're still pretty happy with that. But as the space got more crowded and as it got more competitive, and as people got more of a sense that, there are these drivers of asset class returns that you can bet on independently of a manager. Like you don't have to pay 2 and 20 to get exposure to a factor. Right now, for most of the factors that people care about, you can just buy an exchange traded fund and pay like an order of magnitude lower fees for just that kind of exposure. So the funds realize that's not what they should be selling anymore. They should not be selling just generic returns. They should actually be selling the fact that these returns are uncorrelated and that they can very closely control their volatility. And that's been a good sales pitch, because it does mean that the more you can argue to investors that your returns are based on pure skill and that they can't replicate these returns by buying any other financial product other than a competing hedge fund, you do actually have a lot of pricing power for fees. And the effective fees for these funds are extremely high as a percentage of gains, but it's because what the funds are doing is this very labor intensive thing. They have lots of teams that are spending lots of very well paid time doing incredibly detailed research on a bunch of companies in order to identify these little potential shifts in sentiment that will play out over weeks or months, and that will move one stock idiosyncratically relative to its peers. And they're constantly hunting for these new ideas and finding new trades and things. Like, it is kind of an exhausting thing. It is a lot less like passively allocating capital and a lot more like paying someone to do a job that happens to interface with the market. So capital is an input, talent's an input too. And that model has worked really well. A lot of these funds have gotten huge. Part of their growth is just that they had good returns, and so they were able to scale up. Part of their growth is that for a lot of investors who maybe 20 years ago would have been running a fund on their own, they realize that actually they can get access to more capital, spend less time on investor relations, not have to worry that much about handling all the paperwork and administrative tasks, et cetera. They can focus on the part they like, which is picking stocks. And they can actually usually get paid a bit more. So a lot of these funds end up absorbing that talent that would have previously been people who have their name on the door at their own fund. And so there has been that talent shift towards these companies. And then because the companies pay very, very well for analysts, and that tends to keep on improving, they also have a pretty large talent pool of analysts who they can eventually promote to portfolio managers. So like the story of the pod shops is this story of hedge funds getting more institutional and moving from it is a company where it's basically the founder and then the founder's kind of extended will over this team of a dozen people. Now it's like it's a big corporation, not legally, but like it is like a big conventional corporation. There are a bunch of people who are doing back office administrative tasks in the HR department. It has a logo. It's usually not named after a specific person anymore. It's just like a thing. Like you've got General Motors, they make cars, and you can think of these hedge funds as kind of like General Alpha. Like for any kind of alpha that you want, they will find someone who can provide that alpha. They bundle it all together, charge a lot for it, but after fees, you're still getting really good returns. And actually, if you do want to take seriously the idea that, hey, these hedge funds should be outperforming the S&P, well, for an asset allocator, it's pretty trivial to create a synthetic version of, say, Citadel that tends to outperform the S&P as long as Citadel's returns are good. You just invest in Citadel and also buy S&P futures whose notional value is equal to the value of your investment in Citadel. And then your returns are going to be basically S&P beta plus Citadel alpha. So that would be a pretty, like, if that were a product available to average investors, that would be extremely appealing because it would return like 25% a year, and it would occasionally lose money. Like it would have lost money in 2008, might have lost money in 2022, but it will generally produce really good returns. And unless that model totally blows up, it basically always outperforms the S&P. But anytime, it is just like a fact of life in finance that anytime there is a new way to make money and it involves borrowing money and more than one person is doing it, at some point there is some kind of blow up. And it's usually
It gets arbitraged out, or are there too many people doing it, or what?
Yeah. So there's, I wrote this piece a while ago called The Most Important Chart in Finance, which is just, it's like a stylized chart that shows up in the book Expected Returns by Ante Almada, which is an amazing book that everyone should read if they want to think about factors and asset allocation seriously. It is basically a book that tries to answer two questions, one of which is, what do these general strategies return over time? Like, what is the actual expected return over an indefinite period of time if you buy stocks or if you buy bonds or if you buy stuff that has a high yield or you buy momentum or whatever? Like, that's one piece of the book is just trying to assemble every possible study on what results you get from doing those fairly passive mechanical strategies. And then the next question that the book asks for each of these is why? Like, why do equities return more than bonds? How much of that is just generally they bounce around more? How much of that is that equities do relatively worse when the economy is doing badly, and that's when everyone needs money? And so the losses, like the time when you lose money is the time you least want to lose money, the time when you most value cash. Like I think that was like the most insightful for me takeaway from the book was that's why gold's returns are so low long-term, is that gold is the one thing where pretty much if everything else is going down, gold is probably retaining its value or going up. Like whether it's raising gone to zero or inflation is destroying the value of every other stream of cash flows, like that's when gold outperforms. And the only equilibrium in that case is that most of the time you regret having a lot of your portfolio in gold. And then occasionally you're really, really glad that you had that. Let's see. So that book is talking about just like generally where do these returns come from? But it also talks about this idea of sometimes investors will find a new strategy and they start executing that strategy. And as they execute, as multiple investors are doing the same strategy, whatever it is, you eventually reach this point where the returns, the risk-adjusted returns on that strategy actually look really, really good. The reason they look good is that the absolute return, like the dollars you make on a given amount of capital, has gone down. But the deviation of those returns has gone down faster because everyone else is betting that any deviation from this is going to normalize really quickly. And when that happens, you can tell that this strategy is actually quite crowded. And occasionally something will happen somewhere else in the market that causes people to start liquidating positions in the strategy. And then other people have to liquidate too. Because again, because the returns have gone down and the risk has gone down faster, if you want to get a given return on your capital, you have to lever it up more. So you can end up with cases where the strategy is actually a reasonable thing to do. Too many people are doing it. It suddenly loses money. You actually would make more money betting against this strategy than not. And then sometimes it returns to an equilibrium, which is just the signal is gone. Like everyone figured it out and it doesn't exist anymore. And sometimes it returns to an equilibrium where, yeah, it exists. Like this is the thing you can do. A lot of other people will do it and you can't deploy that much capital in it, but it does get you some slight lift in your returns. And you can conceive of the pod shop model as having kind of similar characteristics where since these funds, they are sending people, like they're hiring out of the same set of schools and then the same kind of investment bank finishing schools. And then they're sending people to the same conferences. They're buying the same alternative data sets. And what they're looking for, because they're looking for fairly short-term catalysts. And the reason for that, by the way, one of the reasons for that, by the way, is that they want a robust sample of trades in order to figure out if someone has skill. Because again, like the whole model is contingent on accurately measuring investment skill. And it's just a whole lot easier to do that if someone is turning over a fairly diversified portfolio many times a year versus if they are picking their 5 favorite buy and hold stocks and they're going to hold them for 10 years apiece. Like basically over the course of someone's career, you might have some sense that they have skill, but you might still wonder if they just got lucky. You can probably take, one of the 5 stocks out of the portfolio in any one of those 10-year periods and say, well, now they underperformed the S&P, so they're not that talented. They were just lucky. So the pod shops do avoid some of that, but because everyone is kind of looking for the same sort of company, like they're looking for intra-quarter acceleration and, here's a reason that investors misunderstand this company. And then here's the catalyst that causes them to figure it out. They end up crowding into a lot of the same stocks and a lot of the same themes. And one of the things that they implicitly do, because they are not supposed to take a lot of factor exposure, they will sometimes identify the unlabeled factors that exist. And like one of them today is there are companies that don't count as AI, but they are exposed to AI because they generate one of the limiting factors, whether that is really, really advanced chips or just electricity. And so if you are running a factor neutral book and you realize that you can actually have some exposure through utilities, like you can find the utilities where they are probably going to increase their capacity over time. You can buy those, short the utilities that won't, and suddenly you've made this unhedged AI bet. But other times it's just if everyone's looking at these same companies and they're all paying attention to what everyone else's sentiment about these companies is, they can end up being crowded into the same names. And if that is the case, then anything that causes one of these hedge funds to start liquidating some of its portfolios will cause other ones to start losing money. And one of the useful tenets of risk management is that returns are not correlated day to day. So if you had a really good day yesterday, you have basically no information on how good today will be, but volatility is serially correlated. So if it was a crazy day yesterday, it will probably be a little bit less crazy today, but it'll be much crazier than average. And because of that, if you are managing your portfolio and targeting a certain risk level, then anytime volatility goes up, you have to shrink your total exposure in order to be in line with your risk target. And so that means selling the companies where things are improving intra-quarter and they're exposed to the secret factor that's not in the risk model yet. And it means buying the companies that are bets against that risk factor and that are slightly deteriorating intra-quarter or have some other issues with them. And so if everyone ends up making similar trades, they can all start losing money pretty fast. Now, this is I think I like books like The Big Short, movies like The Big Short. I think they do a reasonable job of portraying some of this stuff. But one of the things that they have to do for narrative purposes is they have to exaggerate the gap between the people who made a lot of money and the people who didn't. And if you read contemporary things written by people who are involved in this market, like a lot of people during the late stages of subprime were absolutely aware that there's credit risk here. They were absolutely aware that housing prices had peaked in 2006 and they had models about how bad it would be, but it was kind of part of their business model was this kind of thing can happen. We just don't think it can get that bad. And so what you want if you're making a movie, telling a story, like you want there to be this massive skill gap where you have your autistic genius, ex-doctor over here, and then you have your dumb asset gatherer and your slightly crooked mortgage brokers over here. And what's actually going on is like, you still have to be pretty smart to gather a lot of assets. So it's more like they're both like way over here, but there is this little gap in their skills, and maybe the slightly dumber person slightly overestimates his own skill, and that's why he's overbetting. And if you have some selection for just slightly overestimating your own skill, slightly underestimating risk, and you combine that with leverage, then you do tend to have a market that gets over its skis from time to time. So I think with a lot of these funds, though, like this is a scenario they think about all the time. Like it is probably their number one question for any large position that a major portfolio manager has in their book. The number one question is probably not, how do you think you make money? The number one question is probably, okay, how crowded is this? Like how many people are making this exact trade? Because they don't want to be in a position where Millennium has some random problem in one of their quant books somewhere. And so they have to shrink their discretionary equities book, and suddenly Citadel and Point72 and Balyasny and everybody else is losing money on those positions. So like they're thinking about this all the time, but it's not a stable equilibrium until there's been some kind of big drawdown. And then the next thing to think about is, okay, how bad is this? Like I compared it to the Big Short. Most of the people listening to this kind of remember what the economy was like in the aftermath of the mortgage crisis and the ensuing liquidity crisis. And I don't think it would be nearly that bad, because equities are just the least systemically risky asset class of any asset class. Like if you can choose any asset class where things go absolutely crazy for a while, you want it to be equities, because they are a classic risk asset. Like people know that equities are volatile. We've had, equities had a really bad year 2 years ago. So it's not like anyone thinks they're just risk-free. And that means that the people who borrow against just a naked long position in equities, like no hedging, just like, I think the S&P goes up, like they know that this is a gamble, and they're hopefully not gambling with money they can't afford to lose. And if they are gambling with money they can't afford to lose, then I think that was stupid of them. And it's just a question of what year they go bankrupt doing that kind of thing. So I think it wouldn't be a huge deal. And also because these funds tend to have pretty matched long and short books, I also think it's entirely possible that it wouldn't show up that much in the headlines, or you'd have to actually, like, it wouldn't show up in the broader indices. So I have this hypothetical of the day where this model is just completely destroyed, and like some big multi-manager fund loses over the course of a couple of days more money than they've made over the last 5 years, and everyone's freaking out, careers are ending, everyone's rethinking the whole basis of this model. Like the day of peak drama could just be a day where the S&P is down like 0.5% and small caps are up like 2 or 3%. And if you weren't paying attention, you could totally miss it. This kind of thing happened in 1998 with the long-term capital management crisis, where they were running this huge, massively levered fund that was doing a lot of really interesting and clever things in fixed income. And they did have a really smart approach to risk. It was just not quite smart enough. And they got to the point where they could have threatened the financial system. They had to get a bailout that was done by the private sector, but organized by the Fed. And but then the market was not reacting as if it were a financial crisis. The market was kind of plodding along, because the fund was long a bunch of stuff, short a bunch of other stuff, and there were definitely some measures of inter-institution liquidity that got really, really tight and really alarming over the course of long-term capital management's collapse. But in terms of the broader equity market, you kind of had to be paying pretty close attention to notice that there was some systemic threat to the entire system. And that's with a fund where they were a lot more levered than the big pot shops are. So big pot shops will often run with like 6 to 8 times leverage, which sounds like a lot, but if you're going for like a 2% gross return, then levering it up that much is really not that imprudent. And then so long-term capital management was levered like 30 to 1, and then they started losing money, and so they ended up levered at one point more than 100 to 1. And they were involved in a lot of fixed income stuff where there are actually more direct real world consequences, like people's mortgage rates, or like people's mortgage rates in countries other than the US would have changed if long-term capital management had to dump all of their emerging market bonds or get out of all of their convergence trades in Europe. And then, if you have a big company that's a counterparty to everybody, but nobody knows exactly what the total exposure is, then you can't have a breakdown in the entire financial system. But with something like Point72 or Citadel or Millennium, like it's one, I don't think they go to zero. I think they could just lose enough money that they have to completely revamp their model and return with lower leverage and with different kind of risk model. But two, it just would not be the end of the world financially, and I don't think would cause a recession or anything.
Hey everybody, Erik here with a word from our sponsors. Our sponsor for today's episode is Carta, the end-to-end accounting platform that's purpose-built to power the strategic impact of the fund CFO. For the first time ever, private fund operators can now leverage their very own bespoke software that's designed from the ground up to bring their whole portfolio together, enabling formations, transactions, and distributions to flow seamlessly and accurately. The end result? A remarkably fast and precise platform that empowers better strategic decision-making and delivers transformational insights on demand, timely K1s, holistic fund performance data, and so much more. Come see the new standard in private fund management at carta.com/investors. That's carta.com/investors.
Yeah, that's a good overview. I want to segue to your other piece where you talked about sort of the top of the cycle. And first, just to sort of the feeling that that we're in one, and how that's perhaps common. I would also just want to zoom out. Did we have a soft landing, or what's the sort of official read on what happened, or is it still in process?
I think it was a recession for you and me, and it was kind of a soft landing for just like the average American, and pretty okay for people in the bottom half. Just like wasn't a huge spike in unemployment. Real wages, real wages deteriorated more for just high earning white collar workers, and high earning white collar workers are overrepresented in the media business and on Twitter and kind of in the general narrative. So. But I think like for just the average receptionist at a random small business or something, or, the average like car repairman or factory worker or whatever, like, they might have felt the pinch from inflation, but other people were still getting raises. And like a lot of that inflation was higher labor costs or labor intensive things, which tend to be things that are done by lower earners. So, I guess, maybe in a utilitarian sense, it is the ideal soft landing. Is like a bunch of people at Google and Meta have to adjust to merely earning mid six figures instead of high six figures. And then a bunch of regular people still have their paycheck, still have their job. Unemployment is still low. Inflation's moderating, and, rates are coming down. So yeah, pretty, in retrospect, decent. I think central banks could have been a little more aggressive a little earlier in tightening things up, but seems to have worked out okay.
Yeah. And how do we think about when my understanding was that when there's inflation, or when there's QE, it actually hits the lower sort of classes? Or how do we think about recessions that affect sort of you and me versus the working class?
I don't know that QE specifically has that much of a class-based impact. Like, part of the reason that central banks engage in quantitative easing is that it's very easy to value the assets they're buying, and it is a way for them to inject a lot of liquidity into the system without doing anything crazy to asset prices. Like, if you want to move $100 billion of cash onto corporate balance sheets and off of the U.S. government's balance sheet, doing that by buying lots of treasury bonds is just a whole lot more straightforward and will have a much smaller market impact than doing that by buying junk bonds or equities or whatever else, or crypto. So I think that is part of the argument for QE, is that it's actually kind of a gentle way to put liquidity into the system. But then if banks either have some combination of they don't feel like lending, like they still perceive a lot of risk, or the capital they have to hold in their books in order to have a certain volume of loans is so high that it's actually bad for their overall metrics to do any kind of interesting, socially useful, higher risk loans, then they just won't do it. And so the net effect of QE is like, this bank used to have more of a position in treasury bonds, and now they don't. Now they have something that has like a similar yield or slightly lower yield, but they're actually not putting that liquidity into higher risk stuff. So I think there is a useful point about the circumstances in which the central banks do QE, which is when there's very low growth, and it seems like one of the reasons for low growth is that there's just not a lot of available credit, that does hit lower earners a lot harder. A lot of higher earners, we love access to credit. Like, it's nice to be able to have a margin loan. It's nice to be able to have that personal line of credit. It's great to be able to get a gigantic mortgage in order to buy a really nice house. But it's not like we'll be destitute if we don't have access to that. We'll just live in a slightly less nice house and, not have as much leverage in our indirect or brokers accounts. But we're definitely not hurting in any meaningful way. Like, we don't really need anybody's charity under circumstances like that. But if you are let's say you finished high school and went straight into the labor force, and you have your hourly job, and you have a car because you have to have a car to get to that job, but you had to borrow to get that car. And, your life is very affected by whether or not there is freely available credit. So if you, if your kid gets sick and you got to take them to urgent care, and it turns out that you have to spend, a couple $1,000s on whatever this problem is, it's a very different world if Capital One is going to front you that money. And yeah, it'll be expensive to borrow it, but you will be able to pay it off, versus a world where no, that money's just not available, or you're talking to a payday lender, or, you're trying to borrow from relatives, but they are also pretty credit constrained as well. And a low growth world is a world where that kind of circumstance is a lot more common. But it's also a world where interest rates are really low. So people who do have some base of capital and can buy fairly safe assets, we would have a lot of leverage. So, when I started more actively investing in my personal account a couple of years back, margin loans were close enough to free that I didn't really have to think about the cost. And I bought a house in early 2022. And again, mortgage was not like, the payment is not zero, but the interest rate is close enough to zero that it was very much like nearly free money was being shoveled at people like me in order to get us to inject a little more money, a little more liquidity into the economy. And we did. We injected so much liquidity that CPI started ripping, and then that kind of policy had to be dialed back. But I think it's it is way better to look at, there's a recession and then there's a recovery. I think it is way better just for everybody if that recovery has this brief inflationary episode where, the policy that got us out of the recession was simply too aggressive. And so consumer prices started heating up, and then we had to dial it back. That is a lot better than an alternative where it's 10 years plus, it was, I guess, a little under 10 years of very low growth, rising income inequality, because there were a handful of people who were basically exposed to sectors where their net worth was a lot more responsive to low discount rates. And those people did really well, but the economy is not just made up of people who work at big tech companies and people who work at financial institutions. There are other people out there too.
And so maybe can we say more about how should we think about the top of cycle feeling?
Yeah. So I wrote this piece because I was in the Bay Area a couple of weeks ago, and it was just kind of nice to do a vibe check. But I try to be sort of contrarian about the vibe checks, where you want to be buying when everyone's incredibly depressed, and you want to be selling when everyone's euphoric. And then the problem with the whole sell when everyone's euphoric thing is that people could say euphoric for a long time. Euphoria has some self-reinforcing properties. So that's part of what I was writing about, was just trying to get down on digital paper that, kind of how it feels that a lot of the vibe check tells you that, won't necessarily end in tears, but may end in subpar returns over an extended period, because the economy is running reasonably hot right now, and equity valuations are pretty high, and a lot of that is very justifiable based on fundamentals. You have a lot more of the S&P is represented by a handful of really, really great companies that do in fact have phenomenal economics, but some of those economics are just downstream from investor sentiment. So if there are fewer consumer-facing companies trying to do some kind of land grab, then Meta is probably going to get a little bit less ad spending, and so will Google. And if they get a little bit less ad spending, then maybe they're not so aggressive at buying new NVIDIA GPUs to launch the next big AI thing. And so maybe NVIDIA is a little bit over earning too. And it's a great equilibrium. It is a higher growth equilibrium than the alternative, but it is something to think about, that when you look at economic fundamentals at the points where markets peak. It's not that things start getting bad and market keeps going up and then eventually the market flips and starts going down. It's usually the other way around. It's usually that markets peak and then start to decline when unemployment is low and growth is high and inflation is under control and everything looks really good, because things can't look any better once they look really good. It's very hard to shift the economy permanently into some higher growth regime. So we're always oscillating around this like roughly 2% long-term growth trend. And when we're at the high end of that oscillation and multiples on unusually high earnings are also unusually high, then you can have a period where even though the companies keep growing, even though the economy keeps growing, it grows a little bit more slowly, and investors are just way less willing to discount that long-term growth at favorable multiples. And so you suddenly see either a very significant compression in equity values, or you just see this long period where earnings are actually growing faster than stock prices. And that's just a really frustrating thing to see. Like if you look at a chart of Microsoft's market cap versus their total earnings starting in the year 2000, there's this crazy period where, yeah, Microsoft kept growing. Like it was a great company under Ballmer's tenure. Everything about it was great except the stock price, which was not. And then like there were high profile flops, but if it's a tech company, you want there to be high profile flops. Like the alternative is the company's not trying anything and it's a bet on whatever. It's a bet that whatever its early bets were, those bets will actually continue to pay off. And that just never works forever. So I think I think sketching out a scenario like that was just like a useful way to think about this. And I kind of came into, when I started writing that piece, I was feeling kind of bearish. And then I sort of talked myself into feeling a little bit neutral or maybe opportunistically bearish. Like, I don't think that stocks, hit a peak and suddenly collapse. And I don't have any idea how to time that, but it is definitely a time where you should be expecting something like that more so than you should be expecting, another decade like the last decade, where everything goes up. And even if it feels like literally the end of the world, as it did in spring of 2020, like that is the time to buy and things snap back really quickly. Like sometimes you do have this extended period, like from the market peak in 2000, like late 99 to 2000 to the market peak in 2007, I think the S&P was like roughly flat. So you get dividends, but you didn't actually have capital appreciation over that period. And then there was another collapse. And so I think for a lot of investors, it really felt like this is not how it's supposed to go. Like we know stocks go up and down, but the idea that stocks go up and then down and they almost go back to where they were when like 7 years ago, and then they go down again and even faster this time. And it's even worse this time. And then they do eventually come back. But by then I think a lot of people were just kind of disgusted with the stock market, because it did look like if you timed things wrong or if you started investing when everyone was talking about investing, that you just didn't have great returns. I'm sure a lot of people who got into the stock market in the year 2000 actually held on and, finally got back to break even in 2007. They had to feel really envious of anyone who just bought treasuries. And that's just an unpleasant feeling to realize that the really simplistic risk-averse decision was actually the one that paid off a whole lot better. So I think there are always cycles and epicycles in this kind of thing. And it does feel like I guess it is hard to imagine a period over the next 10 years where multiples keep rising and growth keeps accelerating. It could hypothetically happen, but it is a lot easier to imagine a period over that time where the technology keeps improving, the products keep improving, earnings do go up, but maybe a little bit more slower than expected, and valuations just don't respond all that much.
Yeah, that makes sense. I want to segue to another topic you wrote about, which is how high does AI's revenue per usage or per customer get? And so you wrote this, I think, in response to OpenAI shipping a pro version. But why don't you flesh us out a little bit in terms of answering that question?
Yeah, so I think it is interesting to think about what is like how much money per employee can companies spend on software before it just stops making sense. And you can kind of mess with the numbers and find weird ratios in certain cases where there is someone whose job is to manage some specialized software installation, but really you should amortize the cost of that thing over everyone who's affected by it. And so if you look at just how much companies spend on software per employee. Like one, the number does continuously go up over time. That is pretty much the way that software as an industry has to grow. But two, it does seem like in many fields, there is this sort of ceiling where you reach a point where there isn't that much of a marginal return on giving someone better software. And I think like the approximate ceiling for software that you can buy from some external vendor versus software that's built in-house for some specific use case where the economics are a bit different. Like for external vendor software, I think Bloomberg is kind of what anchors the high end of per user spending. And so Bloomberg terminals are like $2,000 to $3,000 per seat per month. So very expensive piece of software, but they are usually a piece of software that's used by someone who's earning an order of magnitude or more compared to that. And if they make that person 10% more efficient at their job, it's break even. And if they make that person 15% more efficient in their job, it's a really good deal. So software in categories like that, where it is a performance enhancing product for someone who is compensated based on very measurable performance, there is a lot more pricing flexibility. So the OpenAI Pro thing, where the original Pro, if it's Plus or Pro. Anyway, the original paid version, it was an extra $20 a month. And then they had this new one that's $200 a month. And so my first thought was, okay, well, what is the thing that's worth $2,000 a month? And by the way, AI does seem like a bigger technical innovation than Bloomberg. It is a more generalizable tool that applies to more situations than Bloomberg. So why don't we consider what it looks like one order of magnitude a month higher and ask what is the $20,000 per seat per month AI tool? But as you get up to that price point, you start to compare it less to, your comparison is less, what is this person worth with or without that tool? And more like, does this tool actually replace a full-time person who is a well-compensated professional? And when you start doing that, I think one of the issues you run into is this sort of liability and kind of chain of command issue, which is that it is, if most of the economic value that someone handles is created externally and their job is just to be an interface with it, they tend to have very little flexibility in how it's used. So there are, if you set aside the software specific point and just ask, what are some of the jobs where there's a really high ratio of capital to people responsible for that capital? You could think of things like commercial aircraft, where you have a small flight crew and then you have some mechanics on the ground, but your ratio of the dollar value of capital per employee who's responsible for the stewardship of that capital is really high. Or you could take an example like a container ship, where you again have very small crew, really expensive ship, really expensive cargo. And then power plants are another example, where it's like there's a ton of capital and then you have a few people who are just like, who are there and they're monitoring things and they're keeping everything in line, but most of what's going on is capital. In a case like that, what you typically see is that the workers have extremely tight constraints of what they can do. And a lot of their job is memorize a very long rule book, follow those rules exactly. And a lot of the rule book is, here's what to do when things go badly, because that's when you need some level of human discretion, but you actually need people kind of pulling in the same direction. Like if the power plant looks like it is heading towards a failure, you don't want half of the people to think that we have to do X and half of the people think we have to do Y. And then you either don't do either X or Y, or you do X and Y, and either way, it doesn't really work out. You don't want a case like that. So you tend to have pretty exacting rules, and AI tools seem like they would have a much lower return for someone who is just going down a checklist. In fact, that is the kind of thing you just want AI to do instead. So my kind of hand-wavy claim was that the more powerful software is, the more you basically have to raise the wages of the person whose job is to use that software, such that most of what you're paying for, when you're paying for decisions, you're mostly paying for decisions made by a human being who you can fire or sue or yell at, or, who also feels some kind of personal commitment to the outcome. And that if you have too high a ratio of AI spend per person, then really the person is like a vendor manager. They are not actually an individual contributor who's doing the work. They are just the conduit through which you outsource the work. And that's just a very different arrangement, and probably one that a lot of institutions just can't get used to. But as AI tools get better, there will be more jobs that pay six figures that an AI model can conceivably do. And they're going to have to figure out how to price it in order to capture that value. Or there may be firms where they kind of build themselves around toggling back and forth between human and machine intelligence on a task by task or project by project basis in order to get the maximum value out of both. So I think it leaves a lot of economic questions unanswered, but that is, it would be a very different world if economists could always tell you exactly what's going to happen over the next 10 years. That's usually not their job. Their job is like conditional on X happening, what happens next? It's economics and science fiction are in some ways extremely similar disciplines in that both of them try to rigorously consider the outcome of wildly changing a handful of variables, but keeping a lot of the human tendencies that interact with those variables constant.
Speaking of not being able to predict the next 10 years, I'm curious, what is your latest understanding on scaling laws and their degree of holding or not holding, or what is our latest understanding there and what that means?
That's a really tough one. Yeah. I think in one sense you can say scaling laws are holding, like if you think scaling laws are all holding, that has become a pessimistic claim, because that is the claim that we can always feed more tokens into the model and get better results. But also if we run out of tokens, then we get worse results. It's sort of like, if you say thermodynamics, exists, is true, is like an accurate model of the world, that becomes less of a pro oil and more of like an oil alarmist thing. If your secondary view on that is we're running out of oil and therefore everything we do will get continuously more expensive and we'll have to continuously reduce the energy inputs. I think that kind of thinking was a lot more popular when solar panels were much less efficient and nuclear was a little bit further out of the Overton window. But it is true that sometimes when you take those rules seriously, they start out being really, really optimistic, like GPT-2 to GPT-3 very, very clearly demonstrated these scaling laws in a really hard to ignore way. But if you do run out of interesting new tokens, then things get harder. But also we spent a long time, most of human history generating tokens without realizing that they're really good inputs into AI. I think when Homer was composing and reciting the Odyssey, he was not thinking that this is really going to help if we convert all of these words into tokens and then try to predict the next one with some massively powerful statistical system, this will make it a little bit easier. So, we were kind of doing that on its own merits and then ended up with this huge corpus of just sequences of words that turned out to be really good training data for producing more sequences of words. And now we have a different incentive structure where for some categories, I think like maybe that is like the next iteration of scaling laws is trying to figure out where are the missing tokens, where are the bad predictions, and then having more people spend more of their time creating those tokens. And this is already happening. It is already the case that people who get hired for producing data or labeling data, like that used to be extremely low wage. You do it in the cheapest parts of the world where people fluently spoke the language idiomatically close enough to what your end user spoke. This was actually one of the advantages that China has, is that they have pretty steep internal income inequality. So they do have people who are close to subsistence, but also speak the same language as the AI engineers. And so they can do a lot of that kind of thing internally. US has a more complicated and more globalized cognitive supply chain, but there are a whole lot more English speakers. So a whole lot more people who can produce training data. And so early on training data, like that kind of data labeling was done by just the lowest earning people. And it was either alternative to not having a job or alternative to having a really bad job. But it is increasingly something that people are paid pretty decent sums to do. And I think it's hypothetically possible that you could have a situation where the majority of code is written by AIs, but the majority of coders are actually making more money because their whole job is find cases where the AI is not writing this function correctly and fix the function, and also try to identify what is the meta problem. So you could, eventually they do solve enough of those problems that their job is obsolete, but that's true for any industry boom. Like the automotive sector used to be like a quarter of US GDP because going from nobody has a car to everyone has at least one car, sometimes two or three, is an expensive one-off burst of capital spending. And so you need to marshal a huge amount of resources to build enough cars to go from carless society to cars are ubiquitous in this society. And then at that point, you have replacement demand, which is just not nearly as high as peak demand. And that replacement demand continues for a long time. And then hopefully by that point, there is some other industry that is growing and soaking up a lot of labor demand. Depending on how optimistic you are about AI could just be the last of those stories where, yeah, this is like a technology that destroys a bunch of labor demand long term, but it creates a bunch of labor demand in the short term, and it makes us so much wealthier that we create new jobs. Like maybe eventually we get to the point where everyone can pretty much have an American, modern American middle class standard of living without actually working, and then we just have a totally different, unimaginably weird economic arrangement to support that. But in the meantime, that's still speculative about economics and politics and human nature and technology. And if you're just looking like right now, I think really the scaling, the thing that is still true about scaling laws is you can't improve the models. You've just got to spend a lot to do it.
Maybe zooming out, it's like use compute algorithms and data. I'm curious where you think we're most bottlenecked, and I'm curious what you think about companies like Scale AI, and if you're bullish on them as either sort of being able to own the data labeling or just sort of the transition between human labelers and sort of synthetic data.
Yeah, so I think in the auto industry analogy, Scale AI is kind of like the UAW, where it is this way to shift a lot of labor into the industry and kind of direct it in a certain way, and they will absolutely charge what they can for that. And that puts them in a really good position. They make a lot of money. They will have to figure out what their long-term model looks like. But I think it is perfectly fine to have an industry or like have a business where your model is this business will only exist for a finite period of time, but over the course of that time, it's going to be incredibly lucrative. And perhaps if we do enough of this fairly low value added kind of predictable stuff, we can move up the value chain and eventually find something that is more of a product, less of a service. And also they seem to have a lot of hustle. They seem to be a very aggressive company that is willing to pivot really hard or when something doesn't work. So it's very hard to bet against people like that based on just like pure secular bets on the economy. I think it's kind of like saying that like being bearish on Facebook in 2012 because Facebook made all their money on desktop and mobile was eating desktop usage. Like you have to assume that if you know that Mark Zuckerberg has known that for a long time, that if you're wondering what they're going to do about it, they have already started doing something about it, and that it is probably a smarter thing. They've probably figured out a smarter way to handle that problem than whatever you would have come up with. That is just, you generally want to bet that people who were in the right place at the right time are going to remain close to right place, right time in the future, even if it's not perfect. So yeah, I think you could be reasonably positive on that. On algorithms and compute, it's just very, very opaque what that actually looks like. I have no idea how to really assess the quality of the current algorithms or how to assess what the possibility space is. This sounds like a good question for an AI that is smarter than any of the existing AIs and perhaps smarter than the people who are working on those tools. But I guess there is a long history in tech of some, one scaling factor being the only one that matters, some other scaling factor becoming more and more important, and people actually adjusting to it and figuring out how to do the right kind of scaling. So if you look at something like the history of CPUs, there was this period where they are getting faster, but they're also getting more power hungry. They're throwing off more heat, et cetera. And you could extrapolate that and say, like, yeah, eventually we'll have really, really powerful computers, but we'll have to have a lot of elaborate cooling systems. And so the one thing you won't be able to do with those really powerful modern computers is put them in your pocket. And then it turned out that there were other architectures that could be much less power intensive, and those ended up becoming a lot more common. And so there are always people who are looking at what those walls are and are already finding ways to tunnel under them, climb over them, go around them, et cetera. But yeah, for algorithms, like, I guess just from like an information theory standpoint, it is just very hard to talk about hypothetical improvements in algorithms because if you can describe the improvement, you are describing the algorithm. And so like the one you could coherently describe the one that works, but if you could coherently describe the next step, then you should just implement that. And if you can't, then you have no idea if this is just the best we will ever be at converting a given amount of data into a set of weights that predicts the next token or not. Maybe if you spend all of your time on this, you have some sort of more artistic sense of like, some of the things we do are so clumsy that this just can't be the right way. This can't be the end state. I think that is probably a reasonable guideline. And I do, just every time I hear about people tweaking hyperparameters and kind of knowing roughly what the magic numbers are, but not really having any sense of why those numbers are what they are. I do feel like maybe there is some meta understanding to this that we just don't have yet. And that once we formalize that it will unlock a new set of improvements. But I would be very much out of my depth, even speculating on this. So I would treat that as like a claim about history of science and about economics, and not a claim about whether or not Ilya knows what he's doing.
Yes. Maybe close out on, you wrote a little bit about sort of AI and property rights as it relates to YouTubers. I was at this party the other night where people made predictions, and someone made the prediction that there would be an AI generated artist who would crack the top 10 in the next year in terms of top songs. When we look at creators a few years from now, how many of them will be AI generated from scratch versus actually just enabled by AI? And everyone has their own little Mr. Beast level supply chain of content.
I'm actually torn on this one, because I think for YouTube creators in particular, and this is one of the points that I made in that piece, was they're already catering to an algorithm. They already know that their cuts should be just as quick as humanly possible, and they've got to smile, and they've got to have great teeth, and here's the optimal length of the video, and here's how quickly you have to get the concept across, etc. Like they know all of that extremely well. All of it's been relentlessly A/B tested, and because of that, it does seem like it's easier to copy that kind of generic schlock. But on the other hand, what I don't know for sure is how much people's fandom of, say, Mr. Beast, how much of that is motivated by, this is a fun concept for a video, so I'm going to watch it. And how much of it is just like, I like this guy, and whatever concept he comes up with, I'm sure he'll do a good job with. And so if it's a parasocial thing, I think you wouldn't have a hugely popular creator who is AI driven. Instead, you'd have a lot of the time that people currently spend watching mass media stuff on YouTube and TikTok. A lot of that time could shift to them watching entertainment that's generated on the fly just for them. I personally think you should probably stay away from that, in the same way that if there is some drug that exists and a lot of people can handle it, and you find out that there's a version of it that hits you a lot faster and is way, way stronger, and it doesn't have as many side effects, like, you should actually stay away from that one as much as possible, because it will probably kill you or mess up your life. This happens with a lot of comparatively benign drugs, like alcohol, obviously has a lot of problems, but there is just a huge difference between beer and hard liquor. And when hard liquor gets introduced to societies that were mostly drinking beer, there's often a lot of social chaos before they figure out what the new norms are around that. There's probably some of this happening with cannabis right now, where there is like the norms around smoking pot if it's very weak and of uncertain strength, versus the norms around like hydroponic, genetically engineered, like this is basically pure THC. If there's a schizophrenia switch in your brain, this is going to be like jamming that switch up as much as it can. You need a different set of norms for stuff like that. So I think that entertainment that is just like perfectly optimized around your personal responses could get really, really addictive really fast, and would probably be something you'd end up categorizing as similar to a drug. But it will probably be popular. Like AI boyfriends, AI girlfriends, those do exist. People do seem to get addicted to them. It does seem to cause some problems. I'm hoping that norms shift away. And I think the best norm shift is basically saying that it is kind of loser behavior to have digital friends and to look at AI generated porn or something. Like that is like extremely loser behavior and also quite dangerous. but not dangerous in a cool way, like smoking cigarettes, dangerous in a stupid way, like crossing a busy street while blindfolded. Yeah, you don't want like this whole devil may care, like I'm in love with my AI girlfriend and I don't care who knows it. Like that is bad for society. If you did have an AI generated celebrity, my guess is that for that to work really well, it would be a celebrity where they don't know it's AI. Everyone who enjoys this person's songs or videos feels like they have a close parasocial relationship. So actually, the thing I would look out for is if you're looking for AI generated mass market celebrity, keep track of which celebrities answer all of their fan mail. Because that's what I would, if I wanted to scale a pop star, it would be like Taylor Swift, but she actually responds to your texts. And she does agree that you are her biggest fan. And she thinks this is really special. And, you know, when you're listening to Spotify, it has a special customized shout out for you. And, you know, if you have a common name, then maybe if she says like, this one's for Jennifer, like a whole lot of Jennifers say, awesome, that's me. Or, you know, must be me because we text all the time. So that's something I would look out for. But it is, so you may, you know, if there is an AI generated or mostly AI generated pop star who does actually get genuine real world popularity, I think we will find out that they were AI generated after they get popular. There will be gimmicks, and there have been gimmicks of social media things that are entirely virtual, like, you know, AI. This has existed for years, like even before the current AI wave. There have been virtual influencers, but it is a gimmick. People understand it's a gimmick. They don't think this person is real, but the AI pop star can fake being real to you and friendly to you in a way that a human pop star can't. But then I think a ton of people will be just furious if they find out that all of these really deep conversations they had that they feel like influenced the next track that this artist produced, that no, that was all just talking to a GPU in a data center somewhere.
Well, one step before the AI girlfriend, and an example of what you're talking about too, is the sort of, you know, OnlyFans. Like I see some people who are trying to build a way to scale sort of OnlyFans interactions with the people, sort of customers. And yeah, it seems like there's demand there, and I don't even know if they care if it's AI generated or not when they're in that desperate of a state. But
yeah, I think that is another thing where it is probably good to have fairly aggressive social norms that this is pretty loser behavior. It is actually probably better. It should be higher status that you were just talking to an LLM versus you're talking to a guy who's sitting at his laptop. He has 20 windows like this open. He's trying to remember which of you just lost your job and which of you is worried that your dog is sick, et cetera. And like, but it's a guy. Like, there's a good Wired piece about this where someone actually tried to get a job as one of the like chat stand-ins for an OnlyFans star. And it was, I started reading it thinking this is going to be pretty depressing. It was way more depressing than I thought.
Yeah. Yeah. Well, on that depressing note or call to action in terms of norms, we're at time, but this has been a fascinating conversation on pod shops, you know, market cycles, and some of the biggest debates in AI. Byrne, as always, pleasure. Until next time.
Yes, indeed. All right.
Thanks for listening to The Riff. Please go follow and subscribe, give us 5 stars, and check out Byrne's excellent newsletter, The Diff, if you haven't already.